Hi everyone. Now in this session we're going to focus in on a particular economy which has grown beyond that middle income threshold and has become now a newly industrialized country and really is a more economically developed country now. And that of course is South Korea. It really is quite staggering the economic development that has taken place in South Korea over the last 50 years, particularly when you consider the fact that it was a poorer country than the likes of Mozambique and Bolivia just 50 years ago. So that really is quite staggering development. And last time, of course, we looked at South Korea's current GDP per capita for 2016, which is really quite healthy. Next up, we've got policy reforms in the 1960s. Now, these reforms began in the 60s and were encouraged domestic savings and international trade. So of course the savings would have allowed Korea to actually channel a lot of investment through into capital expenditure and ensuring the productive capacity was being developed within the economy. If we think back to the solo model, for instance, this is interesting. Remember what we saw there, savings equaling investment there, as a key kind of founding principle of that solo model. So given that that was taking place, that was allowing a lot of capital investment to take place in the development of an appropriate infrastructure. At the same time, South Korea was exposing themselves to international trade, globalization, and highly competitive external market. So very interesting points, and of course there's similarities here between these two areas with what we see with China today, and have done over the course of their development, incidentally. Next point, state capitalism has favoured Korean chaebols, particularly in the 1970s and 80s. So this would mean that the state would deliberately allocate resources in the form of subsidies or provide loans at very low interest rates, or act as guarantor for such loans to be provided to these Korean chaebols. These chaebols are also known as conglomerates, and what that simply means is a firm that operates in many different and often unrelated market sectors. So if you take, for instance, Samsung, Samsung, of course, renowned for their mobile phones, but they also make, for instance, washing machines. Daewoo, likewise, they make cars, they make washing machines, fridge freezers, and so on. And then you've also got the likes of Hyundai. Okay, so these firms were able to really develop and had a high level of priority. Some Koreans, of course, found this principle just to be absolutely wrong, that in effect the government of the state had chosen particular winners, and they deemed the competitive environment internally to be unfair because of that. So that would be one dissimilarity there, but this principle of state capitalism, again, there are certain similarities with China. Next up, these firms still resist further market deregulation. So even today, these Korean chaebols, they try not to allow further deregulation of the South Korean economy, because they want to maintain their particular status and their particularly high barriers to entry, for instance, in those marketplaces. So the extent of their market power means that they deliberately will try and lobby against any further further market deregulation. Okay. A really interesting point about Korea's development is one of the big problems they faced back in 1997. And this was when the Asian financial crisis broke out, firstly in Thailand, but that sent financial contagion to many other so-called East Asian tigers, the likes of Indonesia, South Korea and Malaysia. Those economies suffered quite severely, as well as Thailand, of course. Now, this was really interesting for South Korea as a developmental process, though, because it really exposed the weaknesses within both their financial sector, again a similarity with China's weak financial sector. Further to that, it also exposed the fact that corporate um, policies and corporate governance wasn't actually well run. So, for instance, we can see some of these some of the potential problems here, where you've got favoured firms. It means the actual governance, ensuring the long-term health of those companies, wasn't really taken care of, and many of those companies took on excessive levels of debt. And as a result of that, when they needed to pay that often dollar-denominated debt back, they had to do so at a much, much harder exchange rate, because the Korean won really depreciated as a result of this financial crisis. Okay, so that was interesting, just exposing those key weaknesses within their economy. Further to that, it then enabled South Korea to consider, never again are we going to let this happen and get ourselves into this position where we have taken on excessive levels of debt, where we haven't thought about the long run health of our companies and the finance sector and so on. And it really enabled them to push through certain laws. So, for instance, bankruptcy laws were improved, the financial sector was developed with quite tough regulations imposed at times. Now, all of that has meant that the South Korean economy is today far, far stronger as a result of succumbing to that Asian financial crisis. But for the Chinese, what a lesson to look at. What a lesson to look at this is. The fact that China will not want to liberalize their capital account, as South Korea did, very quickly, and make their currency convertible quickly, while their financial sector is weak, while their corporate governance practices are weak, where they know that they've got not Korean chaebols but SOEs that may have excessive levels of debt that could be exposed to funding problems in the future. Okay, so there's some really important lessons here for China. Now, further to this, these reforms enabled South Korea to weather the global financial crisis in 2007, 2008 really quite well, because there was a lot of concern for Korea. It's a country which stands on its own, which doesn't have a sort of trading bloc immediately around it, as many of the EU countries do, for instance. So I think many people were actually surprised how well Korea did manage to insulate themselves from certain problems, despite how integrated they are in global GDP. I think their trade to GDP ratio we looked at last time, I think it was about 85% off the top of my head there. Okay, next up, we've also got the fact that today South Korea is a really wealthy democracy which prides itself in investing heavily in research and development to generate innovation and that inspiration. This is, of course, the cutting edge growth. We can see the differences here. This was more about that catch-up growth, of course. Now they've moved on significantly. So it's a really interesting example, and it does provide certain lessons here for China. Okay, so yeah, it's an interesting one, but look at the investment they place in and the priority they focus on innovation here. It's really interesting. Okay, I hope that's useful. Now, next time we're going to have a look at Mexico and what they got wrong, and contrast that with Ireland and what they got right in terms of avoiding this middle income trap. Okay, thanks guys.